Good afternoon, everybody. This is Jim Kenney for May the 17th, 2019, for the Option Professor Weekly Market Update. I wanted to wait for the markets to close and get some prices on where they're taking it home this Friday afternoon. So that's why I'm going a little later than normal. As I always say, past performance is not necessarily indicative of future results. And short-term trading, option trading, involves substantial risk of loss. It's not right for everybody. So do check with your clearing firm, your broker, your advisor, and your good conscience to figure out what, if any, trading is appropriate for yourself. And again, I'll be giving you my reviews, my observations, and my opinions here today. Okay, let's get right into it. The big news today is China and Canada and Mexico got the reprieve from Trump as he took the tariffs off steel and aluminum. And of course, that is a prelude to him trying to get them to agree to that new trade agreement that takes the place of NAFTA. Of course, a lot of these deals either aren't happening or are not exactly what they're advertised to be in some respects, because again, the pickup on agriculture in the New Deal is like 0.5%, which is hardly anything. And then the intellectual property advantages that come out of the New Deal, they were already agreed to in the TPP agreements that we backed out of. So there's not a lot of great mileage. And the stocks, just to give you an idea here, let me do a screen share here real quick for you. I should have done that already. Sorry about that. Yeah, so there you go, screen share. And then let's go over here and look at steel and see what happened to steel stocks today with this big news. Well, as you can see, steel hasn't been doing very well. I'll just update this chart for you. You can see it better. You're looking at U.S. steel here. It used to be up at 40 almost, and it's down at 15. So whatever we've been doing hasn't been good for steel. And today's announcement didn't exactly get it to go robustly higher. So the other one, Nucor and UE. Let's see what that did. Give you another example of the magnificent effects of these announcements you see. And Nucor is trading down as well, almost 3%. And that used to be up 70, and it's at 53. So that industry, no matter what you might hear, doesn't seem like it's responding so well in the last 6 months or a year to whatever we're doing with steel. At any rate, that's the news that's going on, and that's what you can see right there. Give you a little bit of better angle on it here real quick. And there you can see. So that's Nucor up in the 70s last year, coming all the way down to 50, back up to 60, and now back on the defensive as well. And this is with the announcement today. Again, you can't slay every dragon all at once. So again, there has been postponement of the auto tariffs in Europe. I guess we're trying to stick with our knitting with China, see if we can get that done. Although, as I've said on this broadcast many times before, I come from a sports background. If you disrespect your opponent, the likelihood you're going to beat them is reduced. And I think a lot of the disrespecting words going along with the respectful words, it's just so much back and forth. I don't think the Chinese at this point are interested in negotiating much of anything. The most likely thing might be is that they reduce their currency. And if they change their currency to offset the tariffs, then that's what they could do. So the bottom line is I'm not that hopeful that we're going to get any kind of a big deal out of China. And if we got a deal, let's go through it with a fine-tooth comb because for them to flip-flop so quickly, it would have to be pretty much a lot of concessions on our side, I would think. Again, trying to get them to change their laws over there is not that easy. Again, yes, there's been an ineffective relationship. Yes, there has to be changes, but is this the only way to go is the question, and it doesn't really matter because this is the way we are going. Okay, what else is happening out there? I'm going to give you a little overview on what my views have been if you're just tuning in. Now, like I say, if you have a question for me, you can shoot it over to my email, OptionProfessor@gmail.com. And again, if you have any other friends or associates who'd like to watch the broadcast, direct them over to OptionProfessor.com to get the link. Okay, let's take a look at this S&P. Put it up here a little bit for you here. Give me a second. And we'll get that right in front of your face, and you can take a look. Okay. So here's my deal as far as my opinion is concerned. We go way down to 2350 here back in December. The 200-day moving average is up at 2750. I was thinking that we were going to go back towards that moving average, and certainly we did, and we did it very quickly. There to there, 400 points and very quick, right? Then once we started getting through there, right? What's the next logical place? Well, it would be near the highs, right? So I was thinking we could approach that high, and what I was reading was confirming it, that we could go up to that 2950 area, and then we could pull back, which is basically what we're doing. Now we pull back to 2800. Look at it. Isn't that where the support is right there? And the 200-day average comes in between 2775 and 2800. Okay, but that's where you are. You're hitting that support that used to be resistant. That used to be resistance, right? Then it becomes support. That's why you're hesitating in this area. Now you bounce back up to 2900. I thought it might try to go into the 2910, 2935 area because there's a little bit of a gap up there. But it didn't do that so far. And that's why I wanted to wait to the close to see where they took this home, because they didn't take it home at a very nice price. It's down 16 for the day. It's underneath 2865. If it's underneath 2865 and then we go and test this 2800 and take it out, there's a possibility of going down towards 2700 or even 2600. That would be my next region where it would be in a oversold area potentially if it got down there. If we get above that line that I told, that gap, which is what, 2910, 2935, that opens the door for 3000. Okay, so those are your numbers. And when the market is way down, like it was at 2800, and the VIX jumps to whatever it did, I'll show you in a minute, then you look at possibly if you want to buy, sell puts, either on a fully paid basis, meaning you have the ability to buy the stock if in fact it's put to you, or if you want to do a credit put spread where you sell one strike price just using a number 2500 and then buy the 2400 and try to make the difference in the two premiums, and at least you have a risk of the difference between the two premiums minus the credit you received. Okay, so when the market goes down and the VIX jumps way up, that's when you want to look towards your put writing or credit puts. You know, not willy-nilly, but that's when you start investigating them. Now when the market's high, as I told you up here, is that's when you investigate hedging on your long positions or replacement trades. Let me explain briefly. Again, this is not going to be exhaustive. That's why I say if you have a question, shoot me an email. But if it goes up to this area, what you do is you think about selling your out of the money call, because obviously when they're screaming up like this, the calls are expanding. You sell the out of the money call, which means you still have the ability to make money between where you are and the out of the money strike. And you take the premium you receive and you buy a put underneath. So if the market goes down, you've got a put underneath to protect your equity. And if it goes up, you still have some upside to the strike price. And then you could roll the call up if you'd like and do other trades, right? But the bottom line is you try to do something that protects your gain. Because if this thing goes from 2950 down to 2650 again, because the Chinese don't want a deal, because the economic numbers are suspected to look weak, because we don't have earnings now until July, so we don't have a whole lot of meat on the sandwich as far as, you know, what you're going to evaluate things at, then you run the risk of possibly having another correction, and a sharp one at that. Again, this 2900 we saw today, if it doesn't get taken out by next week, that could be problematic. And if it takes out 2800 by next week, it's very problematic, potentially, right? Now, I'm going to tell you a couple of other things real quick here. Again, if you don't understand the hedging tactics, if you don't understand how spreads work, you know, you can shoot me an email and I'll try to help you with your questions. OptionProfessor@gmail.com. All right. Now, a couple of things I look at. Transportation average. Why do I look at the transportation average? Because the S&P made a little bit of a new high. But can you see that we did not make a new high on the transports? Let's get it in front of you. I'm not Johnny the Bear, but I definitely think that the market's in a higher region unless they come out with some new reasons to buy. So here you go. You were up at the high there, right? 11,500, 623 to be exact. It's right there on the cursor. And then it comes all the way down, bounces back. It had another rally, but look, we're way off that all-time high, and now it's turning back south. If we take out this 10.3 area, again, and then take out 10,000, the predominant trend on this is going to be down. So be careful, because if they don't believe that transportation, meaning moving and shipping of goods and services, is going to be a very positive companies, that could be telling you something about the bigger economy. Don't forget that GDP number. It was 3.2, and most of it was loading up on inventory before these tariffs went in place. So when you load up an inventory, it gives you a skewed version of GDP. Consumer spending and capital spending on that GDP number stunk. And believe me, capital spending and consumer spending are kind of important. Okay, so let's take a look at the other thing that I look at a lot, which is the Russell. Why the Russell? Because it's all domestic and it's 2,000 companies. And they're relatively smaller. And maybe they give you a better idea of what's going on with these companies. Now, look at the high here, 1742. Did we go anywhere near 1742 on this rally? No. And if we start taking out 1500, you see 1500? You got a problem. So keep an eye on this. Again, when we were up here, I'm talking about looking into investigating covered calls, doing collars and married puts. Okay. If we come down here and it holds, and you think a stock is at a cheap price, but the premiums are big on the puts, you might consider doing a what? Doing a selling of a put if you have the money to buy the stock and are willing to buy the stock at that price, less the premium. Or if you want to do credit spreads, okay? Or if you're suitable and you have the wherewithal and you are willing to take the risk, you could sell puts, but again, you have to be qualified for that. Now, with regards to the other thing you can do when prices are high, as far as hedging, is called replacement trades. Let me give you a for instance. Let's take a look at some of the companies that used to be really good and aren't very good right now, like Boeing. Boeing was up at 446, right? And it was, well, we'll take a look here. You can see for yourself. It was going gangbusters, but the 200-day moving average was way down at 355 when we were up 446. That's too much room between the market and the moving average. And so what does that mean to me? It means that we're probably going to have a pullback, and that's what we did. So if you're up here and you've made $140, why not take the $140 gain, buy the 450 put for $5, and then if it goes up, you still got the right to buy at 450, but you only have $5 cash risk. And if it goes down to 340 like it just did, rather than losing $100 a share, and if you have 1,000 shares, that's 100 grand. 10 contracts up here at $5 a piece is 5 grand. You're out 5 grand up here, but down here your paper loss is as much as 100 grand. So that's why sometimes you replace long positions with limited risk calls if you think that the party has gotten a little hot and the cops are going to show up. You got it? Okay. All right. Now, what else did I want to cover here today? Let's go, I'm going to go around the horn here a little bit and look at some of the stocks that are, well, let's take a look at that VIX. VIX is a volatility measurement. Okay. And my feeling on the VIX is that when it's between about 10 and 15, the market's in pretty good shape and probably uptrending between 10 and 15. Between 15 and 20, you are liable for some drops. And when you get to be 20, 25, and definitely above 25, you can go into the abyss. Meaning what? You can have a spike up in VIX, which means the market could go into a vacuum, like it did back in when? December. Because once you got above 25 on the VIX, can you see we went into the vacuum, right? Okay. And if you look at August 2015, if you look at January 2016, you'll see similar situations. Now, so the VIX has been trading under 15 for a while, and the market's been rising, right? But once it breaks 15, it goes into a more of a seller zone. When it gets above 20, near 25, it's in an overbought condition on the VIX, and you'll probably get a rally, which you just did. But notice the rally took the VIX right down to today to 1486, which is essentially 15, right? So if next week we don't take out 1486 and we start taking out the weekly high here of whatever it is, 17, then it's a possibility we're going to have another correction. So I'd keep an eye on the VIX because the VIX is a little bit of a gauge on, in my view, my opinion, under 15, you're looking good. 15 to 20, you're going to get some selling. Above 20, you're going to get some real selling. And if it gets above 25, you could go into a vacuum. Now, if it comes back down here because it rallies, then again, this is the neighborhood where the VIX should stop if we're going back down. And this is an area where the market may roll over from the 2,900 area, which it just hit today, or ballpark, right? Okay, that's my view. All right, now let's look at some stocks out here that are in the news. Tesla, boy, I think they're losing a little confidence in fuzzy math. Remember George Bush, fuzzy math? Looks like Elon's using some fuzzy math, and it's not flying anymore. So now he's talking about cutting costs. It's kind of like, Money's free until it's not free, right? With regards to Tesla, again, you're up here at 380. That's 3 times it was in that region. What might you consider if you own Tesla up in this region, 3 times banging on it? How about an out of the money call, take the premium and buy a put? And then rather than losing 380 all the way down here to 210, you've got a put up here that's actually making money during the entire drop. Or how about just donating a little money to a married put? I mean, you insure your house, you insure your car, your health. How about that stock portfolio from time to time? Now, when do you want to take your insurance out? When the skies are blue and the sun is out? Or do you want to try to buy that raincoat when Katrina's hitting? Probably better to do it up here. Okay? All right. So again, Tesla's in trouble because again, people are doing the math and they don't like the way the math is added. And these guys are going to have to go to market, I guess, maybe to raise money. And so there's a lot of issues, and people are giving up on it a little bit. Doesn't mean it's not going to go right back up, because it could do anything, because this is a crazy company that has people going what? In and out of it, and speculating up, speculating down all the time. There's true believers in there. They'll never come out, but the people that are trading it have been selling it. Okay, next one is let's look at some of the new issues real quick. Beyond Meat, huh? That's one of the big success stories coming out of the IPO markets. There's other ones I'll show you in a minute. All right, so what do you got here? You got a company that comes out at about what, 40 something, and look where it is today. Today it's at 80. Well, it did roll over. Look, 89. This is another reason why if it had options, it would be something to consider hedging, right? Because you've got what? You've got a company that came out at 40 something and it's at 90 and it doubled, right? And it's a brand new company, brand new. And so basically, you know, when things go crazy on the upside, you might want to think about doing some hedging if you can. I don't know if this thing's optionable, but if it was, I'd be looking at hedging it when it gets that far up. Again, it looks like the party came off a little bit here around 96. So you got a line in the sand now just underneath 100. Let's see how long that can last. The longer it lasts, the more probable you're going to come back into maybe 70, 80. Okay? All right, but that's a success story. Let's talk about some of the other ones that are not such success stories. And that would be Lyft. Now, when Lyft came out, there was a very, in my view, a very good professor out of NYU who was on TV talking about valuations in the 55 to 60 area. And again, this was when the stock was in the 80s. Well, that was pretty good reporting, because it went from 88 back down into the 50s pretty quick. So that was pretty good information. And obviously, the valuation in the 50s seems to be a little bit more of a stable situation for Lyft. As you can see, it seems to be a little bit more stable in the 50s than it was at the higher levels. Again, these companies are losing tons and tons of money. Tons of money. Okay, next one is Uber. And they didn't wait for Uber. They didn't even send it up for a while. It was right down, right from the get-go. Now let's see what it's doing today. Come back up a little bit. Okay, went down from 45 down to 36. But you know, these people who underwrite the stock, they've got to support the stock, right? They can't just have all these people who bought 9 zillion shares and then have the thing collapse on them. So there could be some artificial support. What you want to do on some of these new issues is watch when the lockup period is coming. And if you think you're bearish, maybe right before the lockup period. Lockup period means the people who are holding insider stock, you know, and people that have restrictions on the stock, they can now sell them. It's usually anywhere between 90 and 180 days after it comes out. That might be an opportunity if you still think that these companies may not have the juice that they have, you know, that they've been reported to have. So the day before the lockup period, where you know there could be some selling possibly, then you go and you look at your puts and see if it's reasonable to take a shot. But again, that's something that I would investigate as they get closer to those lockup periods coming due. Let's take a look at a couple of other things in China, because you know we're having this big war with China, right? How's Caterpillar doing? Well, Caterpillar doesn't really like the tariff war very much, because it used to be at 160 and now it's at 120 something. Okay, and it definitely looks like it's on the down right now. Could turn around at any point, but clearly it's not being received as great news. The one that got hit the most today was Deere. And of course, these guys have tractors, and you know, farmers who don't have anybody to buy their grain don't need a whole lot of tractors, right? We're supposed to buy it from them, but that sounds dodgy to me, but who knows? Deere, used to be up at 170. Now it's at 134. Today it lost almost 8% of its value, and that's a pretty big drop to the downside because the Chinese are saying that they're not that interested in going back and talking about being insulted. Probably they're probably being, and again, just because somebody might not have acted well in the past doesn't mean you're going to resolve problems with them by taking a big grapefruit, putting it in their face, and stinging their eyes with the acid. Right. So there's a lot of different ways of negotiating, and trying to look tough on TV might not be the way to negotiate with Chinese. Okay, that's just my feeling. And denigrating them certainly doesn't seem to be working very well. Deer has been just gapping down. Okay, and the volume is getting pretty high. So now we're near the lows on deer, and the volume has been very high. So what would be interesting to me is to price out the puts. Now let's go and take a look at the long-term picture. Well, let's take a look at the moving averages here. Deer's 200 days at 151, and you are trading at 134, so you're about 20 bucks underneath, 15% underneath the market. It's getting a little bit oversold. And again, if they have a deal with China, this thing should turn around and fly. Now, if you look at the last few years, the 120 to 130 area seems to be some kind of support down here. So it'll be interesting to see if it can hold this 120 area. So, if you were thinking a China deal might happen, if you do think that the soybean people and all those guys will get what they want, and he'll be able to, President Trump will be able to run on "I help the farmer," then this would be the neighborhood to maybe start looking around to see if an out of the money put, where you have the money to buy the stock, if it's put to you, makes sense, would be the time to start investigating maybe. What's going on in their neck of the woods? Baba. Okay, Baba. Let's take a look at that. Okay, let's put the chart up a little bit and then down a little bit. And we'll see. This is Alibaba. Okay, down 3.5 today. Had a big run. The Chinese stock market did very good since the beginning of the year as well. They've come up quite a bit. Now they're pulling back because, again, there's no deal. But right now, it's in the 170 area. So it's very key to hold this area because you see those are highs, those are lows. If it breaks underneath here, again, it could easily go back and start filling in the difference between 190 and 130. That's 60 bucks. Half the way back would be 30 bucks. So it looks like going down to 160 might be in the cards if it starts selling off next week. Okay. And then another one that people talk about over there a lot is 10 cents. And TECHY. Hold on. All right, there you go on 10 cent. Let's take it up here and see what it looks like. And this is another one that had a big run after November, December, right? And now it's rolled over as well. Pretty much looks exactly like Baba. If it doesn't hold here, it might go down to 40 and try to hold there. Okay, that's what I think. All right, let's go around the horn here and see what's going on with some of these prices. Some people are thinking that the oil market might not be a terrible place to be. If you're looking at Chevron, you're looking at it at 108, and it's trading, pretty much. Still has some resistance at 110, but if it can get above the 110 area and then 112, you're into new high area. And let's take a look at crude oil. Now, there's a meeting with OPEC at the end of June, and there are some people who are believing that at the end of June, they're going to take off this cutting back production to make up for Venezuela, Libya, and Saudi Arabia. Well, Libya, Iran, and and Venezuela. So they're going to try to make up that difference. If this oil breaks through this high right here, I think you could really get going. So in other words, watch this number 67. That's the former high. If it can break above here, it opens up 75. If it gets above 75, it opens up 80 to 100 later in the year. Again, this is summertime. A lot of people like to do what? Raise their prices in the summer while people need to what? Buy gasoline, right? So be careful. If they do start cutting stuff at the end of June, we could get a reaction to the upside. That could also change the inflation numbers quite a bit if oil gets back on the bicycle. So be careful of that. A couple other things real quick here. US dollar has been in a range of 95, 98 and still at 98. So it's up near the higher end. Strong dollar until we get underneath 96, 95. Again, strong dollar right now. Okay. And of course, strong dollar and inflation that's muted is not going to help the gold shares. And that they've been pulling back as well. They're still hanging above 20, though. So keep an eye on them. If they can hold this here in the 20 area. Again, they had a big run up. When they're up there, you got to hedge. You got to take something off the table. You got to do something. And then it pulls back here. If it can hold this 20 area, which I think is kind of important, it would be good. Getting back above 21, 22. Particularly 22, because that should be some resistance, then I'd start looking at those gold shares again because they could get back on the bicycle. Okay, a couple of other stocks that I'm looking at real quick here. And these are ones that pay dividends. And one of them is telephone. Okay, let me go over these kind of quick because I only got a few minutes left. Telephone, I think, has got a lot of support at 30. So I'm watching it to see if it'll hold 30. As you can see from what I'm going to show you here, 30 is a big number here. You see 30, 30, 30, anywhere between 29 and 30, right? And it's paying a healthy dividend. Now, dividends are not guaranteed, but that's what they're paying now. And they have not announced that they're not going to be paying them. So right now, that's what they're paying. That's interesting to me. Okay, and then there's a couple of cigarette companies. One is Altria. Actually, the same company. One's domestic, one is international. And Altria is paying 6.11 on the dividend, according to my screen. It's at 52.35. And again, it pays a good dividend. And again, this activity, which is not my cup of tea, but around the world, there are plenty of people that are doing it. So obviously, you know, this would be something to keep an eye on right there. And the other one is international division, which is Philip Morris. And Philip Morris is currently, and there you go, up 1.52, not too shabby, pays 5.25. These guys also have cannabis in their thing, so they're getting involved in cannabis, which makes sense because they're tobacco, right? And then they also have InBev, which has Budweiser in there as well. So they have a group of vices in there, but it does pay strong dividends, and it does seem to be a little bit defensive. On the retail side, two defensive ones would be Ross Stores, because, you know, people still have to buy their clothes, and if things get a little tighter, you know, the discount retailer might be okay. And Ross was up nice today, and it pays not much of a dividend, but it does have a reasonable trend going on here. Okay, and if we get above 100 on it, it would look very good. Okay, so keep an eye on that one. And then Walmart came out and said they had the best first quarter in a long time. And of course, they are discount heaven. And they are in the 100 area. And if they can get above this 105 area, it would open the door for them pretty good. Okay, so there's another one there. You know, defensive tobacco, you know, and then also looking for the inexpensive retailer, figuring no matter what happens, you know, people have to go to shop. Although the valuation on Walmart is not that cheap, 34 PE ratio is not cheap. So you got to be careful of that as well. That could get hit just because of valuation, if valuations tighten up. Last thing before I take off, I got about a minute I can give you here, and that's going to be on the 10-year note. Okay, everyone's saying rates cut, rates cut. You know, we're underneath 4% unemployment. We're within shouting distance of the all-time high in stocks, and everyone is shouting out, you know, cut rates, cut rates, cut rates. Well, you know, that might happen because it's a weird world out there. You know, Germany's interest rate went to minus 0.11. That means if you loan money in Germany for 10 years, and you go back and say, give me my money back, not only will they not give you interest, they won't even give you your principal back. They give you 0.11 under what your principal was. Crazy world. They're doing the same thing in Japan. So I don't know what the future holds, but I do know one thing is that we are now down at the bottom here of what the range has been, which is around 230. And it's not going to be showing any type of possibility, in my view, of going to higher interest until it takes out 260 and 280. So the path of least resistance for interest rates is down, but it's also quite oversold down here. And the opinion on a lot of people is uniform. Fed will cut, right? Or no rates increases rest of the year for sure, right? Fed is gone. Well, come on. What do you think they were saying at 3.2? They were saying 3 hikes this year. So when they're saying that down here, you got to be careful that you're not selling into the, buying into the another stupid talk, right? So be careful. 230 area, I think is very important. 225 to 240. If that holds, I think we could be at the lower end of the yields. If it doesn't hold, then I don't think it's a very good sign for stocks. All right, guys, it's time's up. And what I'd like to do now is just invite you and invite your friends and associates to either do two things. Shoot me an email with any question or any follow-up on anything I've talked about. OptionProfessor, OptionProfessor @gmail.com, or share the link or the website so they can get the link. So next week they could hear what we've got to say and get an update. And also shoot me an email. And that's OptionProfessor.com. All right, guys, it's Friday. I'm getting out of here. I hope you're still listening, or if you haven't, you could listen to it later because it's archived. And again, as I always say, good luck, good trading. Have a great weekend, and I'll be back with you next week. Thanks a lot for listening.